sir. Thank you, Paul and company at Notre Dame. Definitely always puts on a fantastic show here. And this one is, no exception to that. I really enjoyed the papers I heard yesterday, Bob and Jonathan, and then Chester's this morning. Chester actually got things a little spiced up here. I'm going to get people even more worked up at this point here, and we'll see what happens. It's kind of intimidating to present this in front of the three former and current.
I should say my paper was much more controversial when I presented it at the Behavioral Finance Conference last year.
I see.
Not being behavioral.
So I've got a lot of SEC people. He won't even give me a second to even talk here. He's already talking. I've got SEC people all around me, so I feel very intimidated here. They know, they studied, and they know, and many of them have probably a great deal to do, for sure have a great deal to do with the reforms that were passed. But I'm going to do what I can with data and my outsider's view, and they can tell me how wrong I am, I'm sure. This is joint work with Emily Gallagher. She is a PhD student, and the one beneficial thing about Emily is she's in residence at the Investment Company Institute, so she gets access to a proprietary data set they have that becomes very crucial to this study. Larry Schmidt, who is a hot guy on the job market here, and will soon have to be making his decisions about where he's going, a couple of top schools. And then Alan and I have been doing stuff for a while here. So this is the second in what we hope is a series of papers. The series is 2 now. Okay, I don't know if the sequel is as good as the original. I don't know how good the original was. Basically on the 2008 crisis, what happened there, and I'll show you a few results about that. This is kind of the aftermath. What happened to, how stable does the prime money market fund industry or sector look after the crisis and after the reforms, and through these couple of mini crises we've had, the Eurozone crisis and the debt ceiling crisis of 2011. Okay, so I don't mean to insult your intelligence, but I didn't know a whole lot about money market mutual funds before I studied this topic. And I maybe like me, maybe you just kind of let your money float back and forth in your 401k account or your Ameritrade account or Charles Schwab account between mutual funds, stocks, and money market funds, and don't think much about it. That's pretty much how I was, and sort of still am. I don't really think too much about the risk of holding a money market fund. Even before I started studying them, I had really no clue about what types of backups there were, whether anybody would come in and rescue me and things like that. Just didn't think about that. I think most people are that way. But okay, so basically money market funds are like mutual funds in a lot of ways. They have the same disclosure, some of the same disclosure requirements, and some of the same advertising restrictions and things like that, but they're different in some very important ways as well. The one thing that people, that the general layperson doesn't understand is that these things are obviously not insured. You're buying an equity slice in a fund. It kind of looks like a debt slice though, because you're buying in and buying out. As you are with a stable value fund, you're buying in and buying out at a fixed price. So it sort of looks like a debt contract, but it really is an equity contract posing as a debt contract. And we could get into kind of more of a discussion that during normal times it is more like a debt contract. In stressful times it's more like an equity contract, and that's sort of interesting. But that's not part of this discussion today. So the money market fund universe is separated into government funds and prime funds, and then there's also municipal funds if you want to be picky and separate that out from government funds. And of course the crisis happened in the prime funds. Prime funds are unique and interesting because they have a lot more flexibility in what they can invest in. They could invest strictly in government securities, treasuries and agency securities, but they have the flexibility to not do that. They can actually invest in a broad variety of securities that have more credit and liquidity risk, commercial paper, CDs, banknotes, repos, all sorts of different things, which brings a lot of flexibility, allows yield to be higher for these types for this sector of the money market fund industry, but also brings greater risks and during the crisis, greater risk of some investors running from the fund. Okay, Just to kind of show you the size of the industry here, if you haven't kept up with it, even before the crisis about here, the money fund crisis was the week after the Lehman default, you can see that the total net assets of money market mutual funds have not abated, even since crisis. They've abated a little bit since, I guess, 2009, but there's still about $2.7 trillion in money market fund assets. Money market funds are part of the M2 money supply, and they're a big part of the M2 money supply. So this is a huge section of the cash economy, a massive section of the cash economy. And these holdings, you might see, probably have reflected less of an aversion from the crisis as they have the drop in yields to essentially zero among money market mutual funds. Even prime money market mutual funds are paying such low yields now that you would think that some of this drop off in assets is probably due to investors simply looking somewhere else for better yields. Okay, basically all money market mutual funds in the United States have a fixed NAV of $1 per share. I mentioned that before. So this, during normal times, this is fine. The reason for, kind of complicated reasons for the $1 per share, this is a rule called Rule 2A-7 under the Investment Company Act, allows these funds to price like that, price at a fixed price. But the idea is to simplify accounting, simplify the way you think about these things, investing in and investing out, something like a stable value fund, but with a lot more daily liquidity to them. And of course, because of this fixed price, the fixed price is basically a fiction that the assets are always worth exactly $1. They're not always worth, they're never worth exactly $1. But as long as they stay within a bandwidth of $1, pretty close, then you're in okay shape. And if it goes, the assets values goes down below $1 a little bit, the fund company can still price at $1 as long as the assets don't get depreciated below 0.5% or 99.5 cents per share. The fund company can still pretend that they're worth $1 and hope that the assets come back up in value. And if they don't, then the fund management company will generally inject some capital, or they'll buy some bad assets to bring the NAV up to back up to $1 a share. But obviously, this divergence always creates the potential that the management company will not step in and rescue the fund, and therefore there could be run-like behavior. This brings all kinds of interesting things like, well, what types of money funds would you most expect to see run-like behavior? And this is sort of what we explored in the first paper. During the crisis, you'd expect funds that have more sophisticated investors that are mixed with less sophisticated investors. You'd expect money funds that were part of a shallow pocket complex, maybe like a Federated, and not runs from a deep pocket complex like Fidelity or Vanguard that have a lot of other assets that are generating income. So you'd feel safe in Vanguard and Fidelity that they would rescue you, and indeed Fidelity made statements to this effect during the crisis week. You would not expect maybe some of these other smaller or less protected fund companies, less diversified fund management companies to do so. Okay, so the literature in this area has kind of focused on two mechanisms for runs. I don't want to get too far off track here, but this is just sort of a review of the kind of the drivers of how people see bank runs, how people see runs from money market mutual funds. One is a deterioration in fundamentals. People feel like the investors realize that they're probably not going to get their entire capital back, their entire $1 per share back. So the first out, try to get their dollars out first, just like the Jimmy Stewart bank here is, that not everybody's going to get their money. So the first people to run get all their money back, and those who are left over do not, because there's something wrong with the assets of the bank. Or the other way you could think of this, in Jimmy Stewart context, is maybe all the assets were just fine. It's just that they were illiquid at the moment, and if investors just stay put, they'll be okay. But if they don't, they can actually make a self-fulfilling. They can make the money fund actually go bankrupt or insolvent by their own actions. And if they would just stay put, things would be just fine. Okay, so there's a lot of literature, E.T. Goldstein has a really nice paper that talks about the difficulty in identifying which of these two, or if both, are taking place at the same time. There's quite a bit of difficulty in separating these two, because some of the externality type behavior can actually make the fundamentals go worse. If enough investors run from a fund, they can actually make the assets less liquid and can reinforce the run mechanism itself. Okay, so let's get back on track here. During the days following the Lehman bankruptcy, if this was what I consider kind of the white-hot center of the financial crisis, if you look at some of the books and some of the movies that have been written and filmed on this, Too Big to Fail, for example, it documents the time right around Lehman, but people forget that one of the real consequences of the Lehman default was this massive run on money markets funds, or this threat of run on money market funds, and this really, I think, motivated the Treasury Secretary and Fed Chair Bernanke to actually take some really big steps of action. The thinking here was that during this week, the whole world was crashing. Okay, and this was, money funds are basically, one important thing about money funds is it's important to understand that they're sort of a nexus of contracts between financial, Wall Street, I guess, and Main Street, I guess is a way to say that. So Wall Street, you think of is providing money, that, all of us investors, as well as institutional investors, and they're providing financing for Main Street through commercial paper, through buying bank CDs and things like that all over the country. So this is obviously a very important sector to study and run, as understood by the Treasury Secretary Paulson and Bernanke. A run on this sector could have spread the crisis very quickly to Main Street, such that every ma and pa corporation or company would not be able to make payroll or do things like that if they can't float commercial paper or things like that to support such liquidity needs. Okay, so I'm not going to run through these things. This is just kind of a recap of all the various things that were done in consequence or during or after the run week of September 15th through 19th, 2008. There were a ton of things done. Some of them were done specifically to prop up money market funds. Others were done to specifically buy commercial paper directly from issuers. But in essence, all of it was done to protect Main Street from Wall Street. There was no, you were talking about this the other night with Craig, or last night, I guess. There was really no concern that money fund investors were going to lose their money, but there was a lot of concern that money funds as a whole vehicle were going to lose the ability to attract assets, and then who was going to buy commercial paper. This was going to bring Main Street down. And just a quickie here. If you look at daily percent flows, here's a timeline. Here's the start of the crisis week. You can see there's a little bit of a buildup. This solid blue line is the prime institutional category, prime institutional share classes. Okay, you can see that if you just integrate the curve, you can see pretty quickly that the outflows were very large. If you want to look at dollars, the dollars were in excess of $300 billion fled out of prime institutional. Some of it likely went into government institutional, as you can see, took some of that money. Other of it probably went into insured bank deposits and things like that. But it was a huge disruption in the asset market for prime institutional funds with that much money. If you can imagine $300 billion coming out of, somebody said yesterday something about the $450 billion being 20% of bank assets. Well, $300 billion is not an insignificant part of commercial bank assets either. You think about that much money coming out of commercial banks in 1 week or 3 days, it would be a major headline event. But you talk to the average person on the street and nobody knows what the money fund crisis is, or the role it had, which is just amazing. Okay, so I don't know what, what that means for the future here, but investors still don't seem to understand the significance of this sector of the market, and I guess that's part of the idea of the variable NAV, is to get them to start to understand that their money is at risk. Let me keep on going here. The main point of this plot is that it was the prime institutional share classes and not so much the prime retail funds. Retail fund owners like you and me pretty much were asleep at the switch. We didn't know what was going on until, maybe it hit the headlines on the 17th that the Reserve Primary Fund had broken the buck, and then all of a sudden a few investors, 3% of investors, withdrew their money, but it really never hit the retail sector. But it could have, I think, okay? It could have had the crisis gain more headline risk, and this is, of course, what Paulson and Bernanke exactly wanted to avoid, was that wide scale of a run. Okay, so in response to this, the SEC, of course, and the industry agreed to several reforms. They worked together on this, and I think these were in general very productive reforms and have gone a long ways toward reducing the risk. But that's sort of the point of this paper, is to see what, in this column here is the 2010 reforms, and this is what existed more or less before 2010. You can see that there are quite a few changes in maturity length that you can hold, a bit of a change in how much of Tier 2 securities, those are the second rating tranche of securities by Moody's and S&P, a reduction from 5% to 3%. And some of the more interesting things, though, about the 2010 reforms are that money market funds no longer can just cop out of doing a credit analysis and just say, no, the ratings agencies say this is good. Our cursory look at this issue says it's good too. We're gonna buy it. No, they can't do that anymore. They have to do an independent credit analysis. It has to be documented, and it has to be reasonably thorough, whatever that means. So the SEC hasn't provided tons of guidance on this, but they have provided some guidance. It has to be in writing, and it has to be, I think, substantive, or some words like that. Okay. So the other thing that's interesting, the other thing besides the independent credit analysis requirement, is that the money fund manager, the management company, must know its clientele. Okay, there was a thinking back from the 2008 experience that a lot of money fund managers didn't know what their clientele, who their clientele were, and what were the run risks of these clientele. And so there is a requirement now to understand, what level of hot money do you have? What are the needs? For example, there was a money fund that had just a few investors in Detroit, and this money fund needed to, Craig knows what I'm talking about here, this money fund needed to understand when the city of Detroit needed to withdraw a lot of money to meet payroll, okay? So, and before the 2010 reforms, this really wasn't a requirement, at least not to the level of that it became after 2010. So here, kind of in general, the types of the general categorical crisis reforms that came from the crisis from the 2010 amendments. Liquidity had to be improved. 1 week liquidity, or securities that could be liquidated within 1 week, had to increase. The percent of that had to increase. You had to know your investor, like I said. You had to there was more transparency of portfolios, so managers have to disclose their portfolios once a month through Form MMMFs with a 60-day delay, so that investors can see how risky the stuff you're holding is. There's an orderly closing process. If there is a run, you can suspend redemptions and things like that. So there are a lot of protections that this thing put in place. And the question was, what effects does this have? Did it have the intended effects? Did it have any unintended effects? And did it go far enough, or did it go too far? Okay. And we're not gonna answer that question, but we're gonna show kind of some of the trends in the money fund industry since the 2010 amendments. We're gonna compare those with some of the trends that were going on before the 2010 amendments, as much as we can with the limitations of the data we have. Now, one of the things that we are limited in is that we have a lot more transparent data since November 2010, because that's when the portfolio holdings had to be disclosed every month, and you can get those through iMoneyNet or through the SEC's website. We don't have any idea what, other than quarterly portfolio statements, what money funds were holding prior to November 2010. So we can't do a thorough analysis of what's changed, but we can do some types of analysis with the data we have. Okay, so so before I get to the data sources, here are the types of things that here are the objectives of the study. First, we want to know, what types of, first we have this unique data set that I'll describe in a second. Can we identify those types of investors that are most likely to run from a money fund? And for this database, I'll show you in a second, we have detail on which institutional investors truly are institutions and which institutional investors are merely called institutional investors, but they're actually a facade that contains, or an omnibus account that contains many natural persons making decisions. So the ICI data set is going to help us to separate that out. We're going to be able to more accurately identify what are the types of entities that actually exhibit run-like behavior or exacerbate flow volatility or chase yield or things like that with that data set. Secondly, we can look at what has changed since the 2008 crisis, where some lessons learned there, and also what has changed since the 2010 amendments. So those are going to be our main objectives in the study. We do that through 3 different data sources. Okay, the first data source is pretty simple. It's the iMoneyNet database, and I think most people who have worked in this area know about this. It's actually not a very incredibly expensive database to get your hands on. If you want to just quickly download data, you can get, for a couple $1,000s, you can get a 1-month subscription and download to your heart's content, or to your PhD's heart's content, and get all the data, including the Form MMMFs data. So that's great. That's a nice boon. And if you don't want it on a real-time basis, you can cancel after 1 month, and you spend your $2,000 and you have a nice database. And it's generally the data set that is used by the industry, the money investors industry, the money fund industry. They have somewhere upward of beyond 95% of assets of money market mutual funds. So basically, if you want to offer a money market mutual fund, you want to be on this system so that you can attract flows. And the great majority are. iMoneyNet luckily has daily total net assets, and from that, since daily interest is pretty small and almost zero now, you can infer from daily total net assets, the change in daily total net assets divided by the prior day's total net assets is % daily flow to a very precise level. It also has some characteristics or some categories. It has whether the fund is an institutional share class or a retail share class. So we have to be very careful about this, because, as I said before, an institutional share class could consist of a big mix of investors. And this was part of the point of the first paper that I was talking about, the 2008 paper. We tried as best we could. We didn't have this level of data with that paper. We tried to figure out what types of institutions are in that institutional share class and are most likely to run. The only way we could do that was we would look at expense ratios of share classes. Expense ratios are very sensitive to minimum investment size. The big guys who are investing $10 million, the Exxon Mobils who are investing $10 million minimum, can get a much better deal than you or I can, or than a small corporation can. So you can categorize funds by their expense ratios and get a sense of how big the investor is, or how big the money is. And we found that there was a lot of differentiation in institutional share class, among institutional share classes of what their expense ratios and therefore what their minimums were. Okay, so there's a lot of difference in this thing called prime institutional that wasn't really appreciated, I think, before the 2008 crisis. So we've got that stuff. We have weekly holding statistics. Now, remember, this is only going to be important before the 2010 amendments go into effect in November of 2010, because at that point we have detailed portfolio holdings. But at least before that time period, we have some sense of what types of things they were holding in terms of summary statistics every week from MyMoneyNet. Okay, and it's important to understand, of course, that a money fund, like any other mutual fund, can have, doesn't always have, but can have multiple share classes per fund. This means that it can have both retail and institutional share classes within the same fund or portfolio. I'm going to call please bear with me, whenever I say fund, I mean portfolio. And I'm going to be specific when I mean share class. I'm going to say class or share class, and this is something that really gets mixed up by a lot of people. When they say fund, they mean share class. I'm going to mean portfolio, the overall portfolio, which consists of perhaps several share classes. Okay, so there can be, in the fund, there can be multiple share classes, retail, and there could even be multiple institutional share classes within the same fund. And the 2008 paper found that indeed, the mixture of these types of share classes can be either good or bad, can either exacerbate or mitigate run-like behavior during a stress event. You kind of think back about some of the theories of run behavior. If some of the money, if there's a buffer, and this was some of the thinking behind having a buffer, is that if retail investors are your natural buffer, then it's less likely that institutions will run until this retail buffer starts to deplete down to a certain level. So you can get these really non-linear type of actions that happen by institutions because of this buffer behavior. And the recent 2014 amendments, which I haven't talked about yet, will actually completely segregate retail and institutional, true institutional investors into two different funds. So funds will no longer have this mixed clientele. So that's going to have some interesting implications, and we think we shed a little bit of light on that as well. Data source number 2 is Form NMFP. I think I've already described that adequately. It's available monthly since November 2010. And data source number 3 is the really unique data source where we actually have a breakdown of the types of shareholders. Unfortunately, it's only available at year end. It would be great to have this every day or every month. We only have it at the end of the year, but it tends to be relatively stable. There tends to be a clientele effect in a particular fund of the clientele types from one year to the next. And I don't have a persistence or a transition table to show you here. Definitely we should put that in the paper, but looking at it, we've seen that there's a pretty good level of persistence or stability in the clientele. So the ICI data set, once a year, the ICI surveys all of its member organizations, and of course, hopefully the member organizations tell the truth and give you accurate information. We've done a few checks on that. You can see in the appendix, and it appears that the data is reasonably accurate. But what each member mutual fund management company reports is for every share class, they report what is the fraction of money that truly comes from non-financial corporations, financial corporations, retirement accounts. Now, it would be nice here with retirement accounts to separate out DC and DB plans, right? Because I think of a DB plan as an institutional account. First of all, I don't own a DB account. And get in on that. But if somebody has a DB account, somebody is investing your money, you don't really have any say on that stuff. Unfortunately, there's no distinction in retirement accounts, but the one thing we can say is that the vast majority of retirement accounts in that segment, or I guess the vast majority of retirement accounts now are DC plans. So we can almost treat that as an individual or a retail investor, a natural person. Nonprofits or institutional, fiduciary accounts, state and local governments, retail brokerage. Okay, so these are things that we think of as being pure natural persons making the decision. The higher items on the list there we think of as truly being not natural persons or institutional investors. So this is really nice because before, a lot of these guys, as I'm going to show you, ended up in this thing called institutional prime or prime institutional share classes.
How do you deal with omnibus accounts? How are omnibus accounts treated in sort of this breakdown?
I don't know. I don't know how they get information on. I'm assuming they somehow have the ability to look through the omnibus, but I don't know. I don't know.
No, they don't.
Okay.
Only the broker has that.
Well, they used to say they didn't
They
have.
don't share.
They don't
Okay.
share.
Okay. Yeah, that's a good question, Craig. I'd have to look into that. Okay, so with this nice data set, we can shed some light, I guess, on I think on where the industry is going. The industry is going with the 2014 amendments or reforms, the newest reforms. The industry is moving toward a very heterogeneous pooling of investors. So true institutions are going to get in the prime sector. True institutions are going to get their own fund that is going to have a variable net asset value, a market-based price that they redeem and buy at every day. And the true natural persons are going to get a different fund or different set of funds, and never the twain shall meet. And so this could have some fairly significant consequences, good or bad. So it's kind of interesting to look at, can we look at today's, or I guess over the past several years, what was the difference in funds that already had a lot of true natural investors and true institutions? That's what we're going to try to do here. Okay, we're going to look at it in the light of a couple, what I call mini stress events. These certainly were nothing like the crisis of 2008, but they did, as I'll show you, they did have some pretty big implications for outflows. And of course, this thing just keeps on giving, the Eurozone crisis, but this was one of the bigger episodes. I guess today we don't think there's, it's no big deal. They're happening every month or so now. Well, this one too, right? The debt ceiling crisis. This was sort of the big standoff that kind of shocked everybody, and there was a pretty big reaction to this. These two things actually happened pretty closely together. The debt ceiling crisis followed on the heels of the Eurozone crisis, but the Eurozone crisis was mostly over, thankfully for our identification procedure. By about the middle of July, this was over, at least by the end of July. And then we had another crisis on our hands, which was Obama and congressional Republicans fighting over how to increase the debt ceiling. So we have kind of two mini crises that happen pretty close together, but hopefully don't contaminate each other. How am I doing on time here?
You've got a little less than 15 minutes.
15, okay, thank you. Okay. So here's an example of the outflows here. As I showed you, the outflows of the major crisis were about $300 to $400 billion. And these mini crises look like peanuts in comparison, but they were fairly significant. You could say, well, this was just a flight to quality and so on, but the debt ceiling crisis, there were outflows both from government and prime funds, so I'm not sure what quality they were heading to, if that's what it was. Okay, now this shows you how. So let me actually go directly to prime institution. I'll skip that slide and go directly to this because this makes the point better. Here's a breakdown each year of the ownership. Now this is from that ownership database from the Investment and Company Institute that I mentioned. Here's the ownership of prime institution. This thing called prime institutional. Okay, you'd think that this is all big institutions, right? From the sound or the name. Well, what fraction truly is real institutions? Okay, so these guys, non-financial corporations, financial corporations, they're down here, and nonprofits. Okay, that's fine. State and local government, that's fine. Funds, okay, that's like another mutual fund or a hedge fund buying a money fund. That's fine. Other institutional, whatever that is, stuff we can't categorize up here. And then the rest would be retail. Well, about half of this thing we call prime institutional isn't even really institutional. It's, with the omnibus look-through caveat, of course, there are a bunch of natural people making decisions in this thing called prime institutional, but they're doing it through some type of trust account or something like that, through brokers, and the brokers are being are buying these institutional share classes because they can get a break on fees and so on and so forth. So this idea that the whole share class, this whole prime institutional share class is homogeneous is really wrong. And so from this, we would obviously like to know, well, how different is this across different funds? If it's the same across all funds, we're probably going to be able to figure out a way to deal with this. But if you look at prime institutional ownership across prime funds, okay, you can see that they're all the way up to the 40th percentile. There are almost no true institutions in these funds. Okay, so this is a cross-section of funds each year. About 40%. In fact, if you go up to the halfway point, you get to a fund that only has 11% true institutional owners. Okay, and then you get up into the 80s. So the true institutions really are in the tail of this distribution of funds, and the majority has almost no or a minority true institutional investors. So it says that, maybe we should think about, how to treat these guys differently, or maybe we can exploit this data set to take a look at the guys in the tail, the funds in the tail that have almost, in fact, I don't show them the maximum here, but the guys in the far right tail actually have 100% or close to 100% true institutions. Maybe we can look at those guys and how they behave differently from the other guys to figure out what might happen once this VNAV goes fully into effect and true institutions are actually completely segregated. Now, of course, we don't have VNAV now, so that's another moving part that we can't predict, but at least we can look at how these guys behave with a fixed net asset value. Another way to drive this home, maybe I'll just go to management companies because I find this more interesting. It's not only true that funds have a lot of differentiation cross-sectionally in how much is owned by true institutions, but management companies also do. So you and I can probably figure out who these guys are over here on the right tail, who have federated, who have more than 95% true institutions owning their money funds, but there are a large number that we really probably don't have to worry about because they consist of really natural persons making the investment decision. So if we think it was really truly the big institutions, which our paper on the 2008 crisis finds, if it's really the big guys with the big investment minimums, the big corporations, the guy at the money desk of Goldman Sachs, etc. If these are the guys that are create the run risk, then that's really concentrated among this area right here. It's non-trivial, but it's certainly not a big part. Yeah.
Just a clarifying question.
Yep.
So you mentioned that your view of retail is that the retail investor is making the decision. Do we know that here, or do we know if there's actually an advisor in between them?
No, there could be a broker. There could be a broker. Yeah.
So there's a middle category, perhaps, that's retail.
Maybe.
Advised by an advisor or institution.
Yeah, and I don't think we have that level of detail. I think we have broker directed, but we don't have whether it's full service broker or discount broker. That's great. That's a great question, though. Okay, I'll speed up just a bit here to be able to show you. So what I'm going to try to show you now is how the main goal is going to be how do these different types of institutional prime share classes and funds that have, and prime funds as a whole, how do they behave similarly or differently in stress events when they have different levels of true institutional owners? Okay, let me actually flip by this one to save a bit of time. Okay, so table 3 is going to take a first look at that. IO is institutional ownership, so we're going to take a look in table 3. We're going to rank all funds. Funds, again, are portfolios, which could consist of both retail and institutional investors, and share classes. And even with those institutional share classes, we can have natural persons versus others, which are true institutions. But we're going to look through all that stuff, and we're going to look at we're going to classify funds or rank funds based on that shareholder database from the ICI on the level of true institutional owners that they have. Okay, so Q5 is going to be the 20% of funds that have the biggest level of true institutional ownership. The money funds, the prime money funds at the portfolio level that have the 20% that have the largest level of true institutional ownership. And if you remember, that consisted of financial corporations, non-financial corporations, etc. Okay? Now, what this table shows, and we're not really trying to make a point of comparing the Lehman crisis week to the Eurozone crisis and U.S. debt ceiling. We're just trying to show, the types of factors. So I don't really want to compare the size of this coefficient to this coefficient. We're just trying to see what was significant then, And the dependent variable here is percent change in assets, or in other words, outflows, percent outflows during the 3-week period surrounding each one of those 3 crises. So the Lehman crisis is September 9th through 30th, 2008, and so on. 3 weeks of outflows is the dependent variable, okay? And let's just focus on this one. Maybe you can see that this is a dummy variable if you belong to this category. If you were a money fund in the highest true institutional ownership segment, you suffered a 20% outflow during that 3-week period. If you were the median fund, you suffered an insignificant, these are standard errors here, you suffered an insignificant outflow during that period. So there's a lot of differentiation there in outflow behavior, even among prime funds, and it looks like it's highly correlated with true institutional ownership. Have the 2010 amendments completely evaded this? The answer is no. Okay, there still is a fairly sizable. You can see that some of it looks like it's mitigated, but again, I don't want to compare these coefficients with these. What I really want to do is I want to compare these coefficients with these, and there still does seem to be a nonlinearity. There seems to be a step function that at about the 60th percentile or so, once you go above that threshold of true institutional owners, there does seem to be a lot higher level of outflows. Okay, again, it's only 3.5 to 4.5%, but that can be pretty disruptive, and that's on average here too. When I look at the higher level, institutions are greater than 90%. This is on top of, so this a fund that falls here will have a dummy here and a dummy here. It doesn't look like there's significantly greater outflows among those super concentrated funds, and that's sort of an interesting feature that we don't quite understand, but it might be because these funds that consist of nothing but the big boys, maybe these guys understand that if they pull their money, they're gonna hurt themselves. They'll probably get, they'll probably break the buck as they pull their money, and the fund will, the redemption behavior will hurt themselves. All these have the control variables that are sort of standard in explaining outflows, yield, liquidity, etc. So I won't go into that. Okay, but now we'd like to know, so I showed you here that true institutions are much more likely to run, and it looks like it's a nonlinear effect. Okay, so which true institutions? Okay, I had several categories there a few minutes ago. Was it the financials? Was it the non-financials? Okay, so if you look at the Lehman crisis, non-financials and financial institutions, these are actually identical, at least for the 3rd digit, were most likely to run during the crisis, but also state and local institutions were as well. And what's happened since then? Well, you can argue that maybe these crises weren't big enough to induce some of these players, or long-lasting enough to induce some of these players to run like they did during the Lehman default. But there still does seem to be some differentiation. It looks like now non-financials are actually sort of the villain, or the guys that are most risky, not financials. So it looks like financials are either, and remember this is the 3 weeks surrounding the crisis, maybe the financials can smell trouble coming, or maybe they're just becoming less, more risk averse, maybe capital requirements are creating this need for safety, but something has changed in this mixture. But there still is a segment of institutions that do seem to be run sensitive. Okay, and if we look at retail investors, okay, we do this in a separate regression, and we only dummy these in this regression, so you can think of this is all relative to institutions which have no dummy variable. Okay, we find that retail investors, what do? They come into a fund during a crisis, and what does that mean? A money fund during a crisis? What does that mean? Well, they're having a flight to safety. Okay, so the retail investors are flooding into money funds, they're selling their stocks, flooding into money funds, and then institutions are pulling their money from money funds through this mechanism and placing it elsewhere. That's presumably maybe government funds or things like that. Okay. I mean, retail investors apparently, don't discriminate between funds. They just sell their stuff, and it goes into whatever default option you chose for your money fund, which could be a prime money fund. Okay, so let me skip this one. I think I'm running a bit low. I'm pretty close. 3 to 4 minutes left here. Let me go to show you one or two more things that I think are really important to our story. One thing is that what types of investors, what types of institutions tend to chase yield? And that's a really important question to ask, because this yield chasing really, I think, could be fingered as one of the great problems that led up to the 2008 run events. So can we find the institutions that are most likely to reach for yield, or institutions in general more likely to reach for yield? And so we look at the portfolio holdings. Remember, we get this now from Form MMMFs. Actually, we can get this from iMoneyNet too, because these are just general categories. So you can see we do the whole time period. And if you look at, so we exclude from this table the lowest two quintiles of true institutional ownership, okay? The dependent variables in each of these are the percent of the portfolio that's in treasuries, percent in agencies, et cetera. That's what each of these columns show. And what you can see is that the true institutions, the funds that are in the top quintile of true institutions, are holding less treasuries, fewer treasuries, okay? And a lot less if they're really overwhelmingly held by institutions. What are they holding? Well, they're holding repo, okay? They're holding time deposits, but they're not holding commercial paper. Okay, so this has actually caused the section, or I should say, not caused, I should say that this quintile of funds actually is averse to holding commercial paper. It'd be nice to have a breakdown year by year of this to see how this has changed. I don't have that at the moment since the 2010 amendments, but I think it basically stays about the same, is that true institutions have pulled back, or do pull back in general, from holding commercial paper. Perhaps that's good. Perhaps that's because they realize that can create run risk. Okay, but it also has implications for what happens when the VNAV and the 2014 amendments go into full force. This segment of portfolios, as I mentioned, will be comprised solely of true institutional investors. And if these types of investors are averse to holding commercial paper, this could have some impacts on the commercial paper market, depending on how the rest of the prime retail funds, what they do, depending on what they do. What's also interesting is to look at the type of strategies that have come about since the 2010 amendments. If you remember, one of the stipulations of the 2010 amendments was to hold more liquidity. Okay, hold more liquidity, hold more weekly liquidity. In other words, things that either mature within 1 week, or things like treasuries and agencies, limited duration agencies, that you could conceivably liquidate within 1 week without a big price discount, without a big fire sale. So it turns out that we found that the higher the true IO, the more there is a barbelling strategy to, and here's how we can show this is, let's see, so I'll just show this one. This one is just an extension of the first one that shows the extreme category. Let me just show this one here. I just got a minute or two left here. So in the columns are the percentage of assets that are maturing within 7 days, between 7 and 30, and so on. And you can see as we go from the lowest, which is basically zero, there are basically zero true institutions in those prime funds. The percent held in less than 7 day maturing assets goes from 28 to 35. That's exactly how it should go, because institutions are more likely to redeem, and they're bigger, and so on. But where have they pulled this portfolio weight from? And you'd think they pull some of this stuff in, but they haven't. They've basically transferred from the 7 to 30 day sector to hold less than 7 days. So they're doing more of a barbelling. They're chasing yield, or they're keeping yield, I guess, by increasing their exposure to longer term securities as well as short term securities. They're sort of stealing from the middle. So that's sort of interesting. Will that lead to a depletion of demand in this sector ultimately? It remains to be seen, but it's an interesting thought. Okay, and then here's a table I'm not going to show that shows that indeed investors value this chasing of yield. Investors tend to flock to funds that have a little bit more yield. So why wouldn't the management company chase yield if that's their intention, if that's their basic motivation is to build the size of the money market fund. And here's the last thing here I'm going to show you, and then I conclude. So this shows a little bit about the yield chasing that I showed before. On the y-axis are prime net yields, average prime net yields, and T-bill rates. Okay, I think this is derived from So we take the database and we see what is the average prime money fund yield for that quintile that has the most true institutional investors and the least, and so on. And maybe you can see a little bit here that the truly institutional investors are getting more yield on average than the funds that are prime but don't have much or don't have any true institutional investors. We make this point to just show that this really reinforces that during normal times, these guys really do appear to chase yield through various mechanisms. And in the paper, we show that they move back and forth between repo and money market funds as repos gain or lose yield compared to money market funds. So they're really chasing yield around in the true institutions, where the rest of these guys, the other 60% or so of these prime funds, really are not doing it, at least to the extent that the truly the high institutional ownership fund. You can see down here, when there's no yield to chase, not much is happening. But this sort of brings about the question of what happens when interest rates go back up. Are we going to see this type of segregation again? And is it going to be that these VNAV funds start chasing yield, or will the variable NAV feature actually mitigate this type of yield chasing? Remains to be seen, but definitely an interesting question. Okay, so hopefully, we definitely haven't answered all the questions about the effect of the 2010 amendments, but I think the key takeaways from this are that we have to shed some light on how true institutions behave, how their money funds invest. They invest with more liquidity, but with a barbelling strategy. True institutions are much more likely to run at least during a minor crisis. And they chase yield and things like that. So it'll be interesting to see once this complete separation of money funds into true institutional versus non-true institutional clientele. It'll be interesting to see if these types of forces are exacerbated such that risks are concentrated in this sector of funds. And we think there'll be some specialists, obviously, in VNAV funds, because there are huge scale economies to creating a VNAV fund, because most of these types of funds will want to provide intraday liquidity. They'll have to price twice a day or more. There's been some talk about that in the press. So this is not something that your mom and pa money fund will want to do. They'll exit this business and they'll be left with the Federateds in this industry, or maybe Fidelities in this industry that'll be doing the VNAV funds. Whether that will concentrate the risks for those management companies and concentrate the risks into certain types of securities remains to be seen, but I think we provided maybe a little bit of insight into that. Thank you.
Thanks, Russ. The discussant for this paper, we have one discussant, and it's Chuck Jaska.
Yeah, I'm not Amy Edwards or Katya. No, I'm sorry. I think, let's see, where's this room is full of people with more expertise than me, and maybe even, let's see, where is this? Did we, oh, here, yeah. And which, so I, with a lot more institutional expertise than me, and of course that doesn't prevent me from having an opinion about this. So the research questions are clear. The research question is whether the percent of institutional holdings of a money market fund is related to flows of funds in and out. During crisis periods 2008 and 2011, that's tables 3 and 4, which he showed you. Fund flow volatility, table 5, yes, it's related to institutional holdings. Repo arbitrage, which he didn't show you, and that is yes, and actually that's fairly strong, and that's stronger on the 90%, the 90% dummy. The prime fund holdings, yes, so it's a percentage of institutional related to prime fund liquidity, yes, table 3, and flow performance. So the contribution is to use unique data to clearly identify an institution versus a natural person. I couldn't help myself, Russ. I mean, are there unnatural people? I know that's not your term. Maybe in Bloomington there are unnatural
He uses
people.
this language, I think.
Yeah, that is not, I know that's not your term, and that's a term the ICI uses, but when I was going through the paper, I'm sorry about that.
Fair enough.
Not a great comment. I buy the findings. I buy the findings. I think the data is excellent. I think they've done a good job on so far, okay? I have a few comments on this, and then what I'd like to do is talk a little bit about extensions, because I think there's a lot more you could do with this. Well, so a few comments on the ICI data itself, the annual survey. I wonder what incentives, why they collect it and what incentives they have to be accurate. I think you talked a little bit about this in the presentation and not in the paper, and I think you kind of need a little more in the paper on this. It's a very unique data set. And you also, by the way, they had to interpolate a few, just giving a sense of how many you interpolate. I know that your view was that they use 100% of the data, some of which is interpolated. I can imagine a referee saying, run the results without the interpolation and run them with. Secondly, flow is never defined as daily flow. And yes, I understand the need to do weekly flow, and for that matter, the 3-week flow around the crises. But gee, it seemed to be interesting if you could look at what happened, the kind of responses during these crises. I mean, you have the daily flow. You also need to show, I'd like to see you show the controls. I get the sense, since this is a series of dummy variables, that there's a degree of multicollinearity going on here. And I can't judge this because the controls aren't shown, but I have this, I have this suspicion. In table 6, which is a table he didn't show, you have the retail dominated institutional core, the dummy variable for quintile 1, the dummy variable for quintile 2, shows sort of an opposite arbitrage. I mean, they're doing the opposite of arbitrage. Now, when repo rate is high, they decrease assets. That sort of needs an explanation here. The linear probability model is, I mean, it's something that maybe you could do something year by year logit. I understand the need to do linear probability since you're using fixed effects. So that raises the question, why do we care about the findings? Okay, so basically I buy the results. Okay, now the question is, why do we care? Well, of course, great data. We care about share classes. We care about the composition of share classes. We care about how people are, how these share classes are put together. And naturally, the SEC cares because this is definitely focused on the amendments of 2010 and potentially the segregation. This will show what will happen when money market mutual funds segregate into pure institutions and pure retail. Okay? But much of the results are in the literature, including the paper number 1. I mean, so the Kaspersky and Schnabel paper finds strong incentives to take on risk because inflows were highly responsive to yield. That's sort of the table 6 result. MMMFs are sponsored by financial institutions. They took on more risk. They kind of have that result here. I know that the results are more, in this paper, are more specific and more well-defined, okay? But, much of this is in the literature. So what I thought of is ways that, things I would like to see extended here. And the paper does talk a little bit about the impact of interest of these big flows on interest rates. And I think you can do a little more of that, a little more aggregate numbers. But frankly, this paper is not going to be about interest rate determination. So that's probably not going to carry the day. So one suggestion I have, and this is related to table 7, or I'm sorry, figure 7, is it is common in mutual funds that slow money is considered to be easier to manage than fast money. You have But the problem is that there's an endogeneity with risk. In this paper, you can compare prime funds with the same maturity structure but different ownership. You know the ownership. And then see who wins. And you can take that figure 7 and do a better job cross-sectional. And see if slow money is easier to manage or harder to manage. Portfolio trading should impose some transactions costs, which should be a benefit for slow money. And I know the slow money, the literature here seems to think of the fast money as being highly competitive and the slow money is not. From a portfolio manager's point of view, fast money is how much harder to manage. If you've got institutions pulling big pieces of the portfolio in and out, that's going to be harder. And you also said something interesting that wasn't in the paper. You said in the presentation that the expense ratios were very different. Well, that's not in the paper, and frankly, I think that's of interest here. Again, this doesn't quite address, the paper's focused on the amendments, okay? So maybe I am talking about another paper. But, I mean, this strikes me as interesting beyond the amendments. I could think of a matched pair of funds from quintile 1 and maybe the greater than 90% quintile. You look and see who wins. See what the returns are. And so the second issue is what's exactly the cost of Rule 2A-7? I mean, we have a set of rules that we had in 1991, I think, and then another set of rules came out in 2010. I mean, I don't remember all those rules. It's fairly complicated. What's the cost? I mean, suppose we lived in a world without the rule. Would the MMM exist? Now, we obviously don't live in that world. But then the question is, we normally think of institutions, and this is sort of, when I was reading through the paper, I had this, out-of-body experience. I mean, I'm normally used to reading about institutions being, more efficiently priced, better governed, stocks with low agency costs, right? Institutions provide the stability in the market. Individuals are behavioral and irrational, and this paper's sort of the opposite. Right, institutions, well, they're not behavioral because they're chasing yields, but institutions are the problem here. I mean, they clearly show institutions are causing problems in this market, and individuals are not. I mean, I thought that was pretty unique, actually. And so I think you could talk more about this, and actually, how much does having an institution cost the MMF, and what do they do with it? Of course, it raises the question of what the MMFs are competing over. And this is something that I sort of thought a little more expansively about this. There's kind of two views of this in the mutual fund market. In the research, we've got sort of the Jonathan Burke view of mutual fund competition. You've got, wholesome, smiling people selling clearly priced products with easy to determine quality, right? The neoclassical view. There's a bunch of studies, Burke and Green, Gruber, Shanghong, Kubik, Carhart, Burke and Green's FMA address are all about great competition. That's not the competition you're showing here. Okay, you're showing, I should make my brother's fun. He's selling stuff. You sort of have a carnival midway going on. Okay, where you've got, so this is a basketball hoop here where this kid is throwing it, right? This is throwing the hoop. I mean, this was when I was a kid. I got taken many dollars on one of these things. I mean, this is the hoop's not round. It's not a regulation height. So we've got we've got mutual fund agency costs. We've got broker sold funds. We've got short-term trading issues. We've got tournament ownership, and it turns out maybe we have a Rule 2A-7 basketball hoop. Okay, and maybe what's going on here is, and so. Why is it always true that mixing institutions with natural persons is so toxic? What is it about? Are there funds where it's not toxic? Is this something that now mutual fund managers and sponsors are giving up? They're not going to have the right to mix. Okay, so what's the cost of not having the right to mix? It's certainly not the case that they were unaware of these kinds of runs before. Okay, I'm sort of thinking about the sort of optimal run literature in banking, in banking theory. Why is it that this is always a problem that we need to fix? You could have, I think, a fair amount to say on this literature. Is it always as simple as slow money provides a buffer for fast money? Okay, how about non-crisis years? I mean, how does it compare there? I know that you're not going to find runs there, but at the same time, do we have the, and this goes back to the slow versus fast money. Are the yields better? What happens if in the Q3, Q4, where the mixture is more even? Okay, does it matter how much slow money it has, and does that matter over time? Now, again, the survey's only every year. Okay, the other thing that occurs to me is, do retail investors know that they're mixed with institutions? So I very much like the paper. It is focused on the 2010 amendments, and I thought they did a great job answering what I think of as a narrow regulatory issue is what is the likely effect. Okay, I just think you have the data that can ask much bigger questions. Okay, thank you.
Yeah, Chuck, thanks. You obviously read the paper very closely. Lots of great comments about how to push the paper and to talk about results. The only thing comment I had was that the expense ratios of the different quintiles, I think, were in table 1, but otherwise, yeah. Anyway, we can talk after. Everything you said is well taken.
We have a few minutes. Anybody have questions for us?
So Russ, I think in an earlier slide, you had mentioned the potential alternative policy choice, which would be to segment the liquidity rules for the funds by whether they're retail or institution. You have it at the bottom of one of your slides. And that was not ultimately the policy choice in 2014.
Okay.
So I was curious as to whether you thought there's still something left on the table that should be done, because obviously we didn't go through it.
To discriminate the liquidity rules between prime,
and perhaps I read that wrong, but I thought you had
prime
that at the
retail
bottom.
and prime institutional.
Right.
I mean, yeah, the flow standard deviation results, the flow standard deviation is much higher for funds that have more truly institutional investors would indicate that. But I wouldn't know how much more the liquidity. Yeah, I would think more liquidity for true institutions would be right. Yeah.
And then if you had looked at just your study, we had a DERA study as well that we did that argued there was a need for more reform. But if you had looked at just your study of the 2010 amendments, would you have come to the same conclusion based on this analysis?
That more reform was needed?
Yes.
That's a tough question. I mean, I think that there are, I guess, pros and cons to that. I think some of the way I interpret the results we find is that the amendments have sort of, I think, pushed even more heterogeneity. Does that mean that we need more amendments to take care of, what the first amendments? Maybe the first amendments were good, but they pushed some, they had some unintended consequences, and so more things need to be done. I wouldn't disagree with that. But it's not necessarily independent of the first set of amendments, if that makes sense. Yeah.
So Russ, those funds, I want to talk a little bit about retail investors for the funds. So are those funds, can you classify them into directly sold or sold to brokers?
Yeah. We have a category direct sold and a broker sold. Yeah.
So for the retail investors, their behavior, are they different if they're sold to a broker or they're directly sold?
Not that we've seen yet, but we haven't looked in detail at that discrimination.
Because I think that would be interesting to answer the question about the broker's role in terms of actually stabilizing or destabilizing the flows.
Okay. Yeah. We haven't looked. Yeah, that's a good point. Yep.
Kathleen?
Yeah, I just wondered if you had thought about putting in the shadow NAV after, just to see whether any change in flow had an effect, more or less of an effect on the shadow NAV, because you have it now after 2010, right?
So you're saying use the shadow maybe as a explained variable and see if,
Right, except if
see if
they're
flows
running.
ahead, okay.
Right, if
That's
they're
what you're
running.
Right, okay, that'd be a good idea.
When you
Q5, right,
go up,
Q5 has become more concentrated with true institutions, has their flow impacted, right, I think that's a good idea.
Made it more volatile.
Yeah.
So I had a question about the state of play with respect to the disclosure of the holdings. What's the, you made some reference to this earlier in your talk. What's the current frequency of the disclosure of the holdings and the thinking with respect to how frequently the holdings are supposed to be disclosed? I can sort of see this going either way. And I'm not sure this is a context where necessarily more transparency is better. Indeed, at the start of the week, there was an article in the Wall Street Journal about Vanguard's ETF and why they don't want to be disclosing daily, because basically they're concerned that they're going to get, basically that their ETF investors are going to get, in effect, ripped off by others who are kind of who are fronting them from the disclosures. And it would seem to me in this context, if there is material run risk, it would be the disclosures that would enhance the run.
Yeah, but you have
Could
to,
enhance the run.
but you have to remember that these are monthly only disclosures
It's only
with a
month-
60-day delay, and these guys
Oh, it's
are.
only with, okay, so it's monthly, it's
Yeah.
60-day delay.
I mean, so they
Okay.
half the portfolio is matured by that.
Yeah, okay, 60-day delay. I didn't realize about the 60-day.
That's why these guys have 60-day delay, yeah. Putting words in your mouth.
Okay, thanks. I guess we have about a 15-minute break.